Hey, it's Clay at claytrader.com, and in this video, as you saw from the title, let's walk through how to build a trade plan and manage it. And I want to give you an actual case study example so you know that I'm not just sitting here talking in theory. I want to show you something, and then we'll see how it played out in the real world. So what you're looking at here is an alert that I made to my private community, which you are more than welcome to learn more about if you want to go to claytrader.com/team. But this was an alert that was made, and I want to go through exactly what I was looking at and what sorts of dynamics you need to be considering as you build yourself a trade plan. Now, before I go into it, I should note that this will be applied to a futures trade, but this general concept should be applied whether you're trading stocks, options, forex, or anything else. This is just a general framework for anything that you are trading. But like I said, here I am trading an actual future. So, how did this all work out? Well, the first thing that you need to focus on as a trader is this: what is your general idea? Keyword being general idea. And in this situation, my general idea was that this would want to go down in value. So immediately I'm starting to think I want to get short. For you beginners out there, short means the ability to make money if prices go down. So maybe you've heard of shorting or going short. Those just mean make money if prices go down. So that's where my mind was at from a general idea. How did I arrive to this general idea? Well, in this situation, we had this big old red candle right here, which in my mind helped to fortify the overall trend. What was the overall trend? Well, when we look at this moving average right here, which is the 21 EMA, you can see that it was already starting to head downwards. But after that red candle, notice how the angle of it increased that much more. So that's what I mean by solidified what was sort of already there in terms of the trend. So that got me thinking, okay, more bearish, more kind of just, I think I can make money if prices go down. But was there anything else that helped to fortify this idea of price wanting to go down? Well, right here, check this out. Price was down here, made a move up, and then what happened? Came back down. And what do you know what? Right now, the price has come back up. Now, does that mean that for sure, guaranteed, without doubt, the price is going to once again come back down? Of course not. That is why the next part comes into play, the stop loss. Whenever you are building a trade plan, yes, you need to have a general idea. Yes, you need to have reasonings for that general idea, but you also have to be able to say, you know what? I could be wrong. I might actually just not be fitting into what the market actually has in store. And you know what? That is just part of it. Being wrong is part of the game. If you are not able to handle being wrong, then trading is definitely not for you. Stop right now, go find something else to do. But that is also what's one of the big battles is you've got to be able to admit that you're wrong. And part of being wrong is, okay, well, where am I going to admit that I was wrong? And those are the areas where you're going to want to put your stop loss. Because at some point, you've got to wave the white flag and say, yep, all right, I got this one wrong. So ask yourself that question. Where would I concede? Where would I wave the white flag and say, all right, yeah, I got that wrong? And that is where a stop loss would be. So in this situation, my point of, okay, I would be wrong, I set there as that red line, which you saw in the previous image. Where did I arrive at this? Well, if you go through the history of things, you can see some dynamics here where this was an area of support, was an area of support, was an area of support, was an area of support. And when levels of support are broken, there's a general rule in charting that states they tend to act as resistance. Now, tends to, that doesn't mean they're guaranteed to, but looking here, do we have any evidence that this rule is actually playing out? So from the theoretical world of, yeah, supports should act as resistance, is there anything playing out that shows that it's actually true? And yeah, we have an instant right there. Price came up there, so classic. Or support now acting as resistance. And then right there, resistance now, or support, once again, acting as resistance. So does that mean it's for sure guaranteed going to happen again? Of course not. But there is some logic behind it. There's a reasoning behind why that would be my point where I think that's the resistance, but if it's not, yeah, it's looking like I'm probably wrong and I got to just get out. So that is why my stop loss was slightly above each of these areas. So that is the white flag area up there. That's the area where, I'm going to wave my white flag and just have to say, you know what? Yeah, I got that wrong. It's looking like this thing doesn't want to go down. It's looking like it wants to just continue to go up. And then the final reason for that, I should have noted that, is we also have the 21 EMA, which you can see right here is actually already provided resistance. Not a shock when prices are down below certain moving averages. Those moving averages tend to act as resistance. And once again, we have tend to, meaning theoretically, But in this situation, you can see that we got some confirmation from it right there. So that is the first phase. Where are you going to admit that you're wrong? Where do you think that, all right, if it hits that point, I need to just get out? That's big part of a trade plan is your stop loss, because that is within the risk management department, which is what's going to keep you alive as a trader over the long haul. Has nothing to do with making money. A blind drunk monkey can make money as a trader. It's about, what do you do when you're wrong? And the first phase of what do you do when you're wrong is, well, do you know where you're going to admit you're wrong? And then are you going to build risk management around that? And the most simplest form of that is again, that stop loss. I know I'm really hammering home the stop loss, but it's almost like a stop loss. Risk management is really important to trading because it is. And don't take my word for it. Go find any trader that you trust and be like, hey, I saw this weird looking guy on YouTube, and he said that risk management is the most important thing for us as traders. Do you agree or disagree with that? And I'm hoping they say, they should say, if they're somebody that you really trust and you believe them to be a quality, successful trader, they should say, yeah, absolutely. Risk management is what keeps you in the game. So we have our stop loss. Well, now we have to get a little bit more practical in the sense of, well, we want to take the trade. So where are we going to take the trade? So the other part of the trade plan is one of the more obvious ones, the entry, right? Where would be a spot to enter? And I'm not saying any of this is how you would have to take this setup. I'm just explaining the different parts about a trade plan and then how I personally applied it to this one. So in this situation, as you saw in the image, the E was standing for entry, but it is that white line right there. So why am I looking at the white line? Well, or excuse me, the yellow line as an entry point. In my mind, yeah, I'm thinking this thing wants to go down, but I'd like a little bit more confirmation. Because yes, I think that's the case, but as of right now, it is going up, but maybe I could get some sort of confirmation. So what would be required for the price to come down to that area right here? Well, this little green candle here would have to fail. It would have to go back down, right? Because as of right now, the current price is right there. So if I want to get filled right there, that is going to require a failure of strength to the upside. So a failure of strength to the upside within an overall bearish context for the reasons I've already discussed, that would be my final little bit of evidence for me to be able to put my money where my mouth is and say, yeah, I want to get short right there. So that is where that entry point is coming from. I want to see a failure of strength. This is a little bit of a support in and of itself. So, but based on the mere fact that if the price comes back down, that would imply that this candle has failed, and that's a good step in the right direction. So that is where the entry point came into play. Now we've got to think about, okay, well, where do we think the price can head? And this is where a lot of beginners start to kind of get a little confused, because I understand that logic of, okay, so, and I'm just going to use a stock example here. Again, this is futures, but stocks. Okay, so when I buy 100 shares, then that means when it's time to get out, I sell 100. And you don't really think about it and realize there's no reason. You don't have to get all out with whatever you bought. You can do partial sells. You can scale out. You can just slowly take profits along the way. So always remember that. If you buy, so in the world of futures, if you get 5 contracts, that doesn't mean you have to get rid of 5 contracts all at once. No, you could get rid of 1 contract and then another, and then maybe 2 more. Same with shares. If you buy 100 shares, you don't have to get rid of 100 shares at once. You could get rid of 25 and then maybe 75. And then, so just keep that in mind. You are able to scale out. So don't look at this like, all right, I got to find some sort of ultimate price target because that's where I'm going to just get rid of everything. No, look and see if there's some movements along the way that can, would be sensical for you to lock in some profits. And a great way for trading within a trade plan is, well, what is your actual risk? So we know that this is my entry point, and we know that this is the stop loss up there. So let's just call this what we're going to call the risk box. So that box right there is representing the risk that is being taken on the trade. So a general rule of thumb, and I'm not saying it's got to be this way. So again, I'm reiterating these are general frameworks, things that you need to be considering as you build trade plans. But as a general rule of thumb, a great area to try to mitigate some risk, to try to take some risk off the table via 2 forms. Number 1, you're putting profit in your pocket. And way number 2, you're lowering your position size. So as your position size gets lower, yeah, your risk also gets lower. And a great way to do that is just to look at that risk box and say, okay, well, what happens if this same exact size box was in my favor? So I'm trying to match it up. Maybe that one was a little bit bigger. But this is supposed to be a mirror image. And the question becomes, okay, does it seem possible? Does it seem plausible that the price could get down to right around here. Why right there? Well, that is the bottom of this risk box. And if you're saying, yeah, I can see that being a very realistic scenario, then right now you know that you're beginning to form and have a logical trade plan. Whereas let's just say the box or the bottom of this box ended up being like way down here. Well, I mean that's a pretty big requirement in order for you to, be able to get money. If the price has got to go all the way down there, that's getting a little sketchy at that point. But here I would argue very modest. In fact, I think a more than reasonable spot where the price could head to is just simply if it, went down and revisited those lows down around here. So, I mean, not even requiring it to break the lows, but even if the line came to down here, I'd say, okay, I can see the logic there because all you're doing is requiring it to get down to these lows. But in this situation, the requirement is not even that it gets down to the lows. It's just, can it get down to here? Again, can it get down to here is based on the size of the risk box itself. So in trading lingo, if you're risking $1 per share or what have you, then is it plausible? Does it seem reasonable that you could at least get $1 in your favor? If you're risking $2.50 per share, does it seem plausible? Does it seem reasonable that you could get $2.50 if the price were to move in your favor? And instead of just looking at those numbers, I'm just trying to make it visual by shapes. So if this is the shape of your risk box and you make the mirror image in your direction, does it seem reasonable that that could actually happen? And in this situation, I like it very much so, like I said, because we have these areas of support right here and it is already bounced. And then that is where everything is settled. We have a general idea. Now we've narrowed down that general idea to have, okay, where am I going to be wrong? Where I admit I'm wrong, stop loss. We have the practical, well, we've got to get into the trade. So we have that. And then we have figured out some price targets in terms of, all right, based on our risk, do we have logical and realistic targets of where the price could head, where we could begin to scale out and put some profits in our pocket. And then we're going to need to manage their trade too. And again, this is where there's different schools of thought, but there is still the general framework school of thought of, yeah, you're going to want to manage the trade as things play out. So let's just see how this trade went. So you can see right there, that next candle, the price did come down here. So it would have been filled. So the fill happened right there as the price dropped down below that level. And then you can see it did bounce back up a little bit, but notice on the bounce back up, it's not like it took off any stop losses or anything like that. Oh, and I should note that, remember our risk box was about this big. So if we just, right about there. Yeah, I think we can all agree. Do these two boxes, this distance from yellow to red, does that look about the same distance from yellow to green down here? I think that's very similar. But so that's where we're going to at least take off our first profit. So we can, again, mitigate risk by locking some profit in and lowering our position size. So we have the next candle there. Look at that. Again, up there right off of that moving average. Came back down. And as a reminder, this is not theoretical. This was literally posted as an alert, as you saw at the beginning of this video, to the chat room community. Next candle here. You can see it does come down there and hit the profit. So our first profit target has been hit. Now we've got to start to think, well, do we really want to leave our stop loss all the way up there? Now, some people say, yes, let the position work for you. Cool, that's fine. If that's the school of thought, I'm not going to push back. I'm just saying at this point, and maybe you would say, no, I don't even want to wait until this point to start to consider maybe starting to move my stop loss down. That's fine too. But my point is that at some point you're going to, and I'm saying point a lot, but there's going to be a moment where you're going to want to start to really consider, should I start to move things down? And in this situation, it becomes more than valid, and you have a great opportunity now to guarantee a winning trade. How so? Well, remember, our entry point was that yellow line there. And now look at the high of this big red candle. It's right there. So that in and of itself serves as a little miniature area of resistance. So it's a very valid spot for you to bring this down, still put it slightly above that area of resistance, the high of that candle. But look, it is now in front of the yellow line. So now this is guaranteed to be a winning trade. Beforehand, at this point, if your stop loss is up there and if this thing bounces and takes you all the way out, that could still be a losing trade. Now, granted, it's going to be a smaller losing trade because you did lock in some profit, you did reduce your position size, but the threat is still there that could be a losing trade. But you can completely eliminate that threat by managing the trade in a way where you bring your stop loss down, you get it in front of your entry point, that yellow line, but it's still in a logical spot. Now, maybe you're like, you know what? That's a little area of support right there. It's been broken, so I want to bring it a little bit down below that area right there. Some may say, you know what? figure out 50% of this candle and put it a little bit above 50%. Again, all these, I do what works for you. But think about it, we're still all under the umbrella of managing the trade by starting to bring our stop loss down or trail our stop loss in trader lingo. But in this situation, let's just keep it up there for the sake of kind of simplicity. And let's see how, now, next point would be, all right, well, where's the next profit target at? At this point, I could see, all right, well, let's go down to these lows right here. So if it can now move down to there, I'm going to take off. So in this situation, if you had 3 contracts, for example, you took off 1 contract already, then maybe you're looking to take off another contract there. If there's shares, I don't know, you had 100 shares, maybe you took off, 25 right here, and you're looking to take off another 25 right there. Again, give and take, but let's see what happens next. And just like that, and that's why I love this example, because yes, it's easy for me to figure out and find one that is an absolute monster banger home run trade. But the reality of the matter is you'll have a lot of trades that do this, that are looking really good, and then they come up and knock you out of the trade. And to be fair, well, what happens? See, that's why you want to leave your stop loss up there. Okay, fair enough. Well, that next candle would have knocked you out up there anyways. And in that situation for the people, again, I'm not even saying necessarily there's anything wrong if people did want to still give their position plenty of wiggle room and leave their stop loss up there. I'm just saying in that position, yeah, they would have been more than likely having a losing trade, whereas the people that brought it down to make sure that it was a guaranteed winning trade, they'd have been stopped out here and then saved from that big spike up. So overall, it did work out nicely. It would have been a winning trade, assuming, depending on the stop loss strategy. But even if you would have been stopped out there, it would have been a much more modest loss for the reasons discussed. You lowered position size already, and you would have locked in some profits. But that is the anatomy of a trade plan. Get that stop loss, get the entry point, and then figure out and make sure that where you think the price could head in order to, where it needs to head to make it worth the risk that you're taking. Factor those all in, and then, of course, that's all taken in place within the context of having a general idea of where the price may go. So I hope this helps. If there are any other questions on it, leave those down below. But also one more thing that I want to just personally invite you to, and that is this free live webinar that will walk you through how I'm using the tool. And I gave you a little insight here about how I'm using charts to build consistency, manage risk, and then also cover some other very, very key frameworks that a lot of people don't quite understand. The site's been around since 2013. The channel's been around since 2013. So I've come across a lot of traders, and a lot of traders, they have the best intentions. They want to do things right, and they think they're doing things right, but they just have a few little things that are off. And in trading, that's all it takes. A few little things being slightly off will cause you a whole lot of headaches. So this class is also going to be geared towards making sure you have the right approach and the right framework so that you're in the best possible spot to succeed. So if that sounds like if anything that could be of value, then check out claytrader.com/live, or just check out the link in the description box so you can learn when the next live class is. But again, I hope this helps. If there's any questions, leave those down below. But yes, start to build trade plans wisely by going through this thought process and the framework that you just learned about.